Hello traders, this is DayTraderRockStar, and today's video is going to be a video breakdown of the system, especially for the newer members here at DayTradingradio. We've had an influx of so many new traders, and when I say new, both new to the site and new to trading. And when you're new to trading, you have a lot of questions. You have to remember that we've been on doing Day Trading Radio here since 2007, so there's a lot of information that I do cover. It could be overwhelming to a newer trader, and do not get too overwhelmed. It really comes down to the most simplest concepts. Now, what we're going to be talking about here is futures trading in this video, and I'm going to follow up with another video on stock trading. But the future trading is for intraday scalping or day traders. And now these techniques can be used on any different index trading vehicle, but being here based in the U.S., I tend to use it on the Nasdaq, the ES futures, Nasdaq futures. You can use it on Dow futures, Russell, any type of futures, oil, gold, even Bitcoin works great. All right, and it's very important that you pay attention to what I'm going to talk about today, because after going through and talking to hundreds of traders over the last couple months, and doing one-on-ones and coaching and stuff, I get the same questions all the time, mostly about how are my charts set up, what am I looking at, what's a pure divergence and stuff. So I want to try to clear up a lot of those questions in this video. All right, let's just start off with the chart here. Now, when I'm trading, I'm usually trading on a small time frame, in this case, the 1 minute time frame. Now, the 1 minute time frame could easily be the 3 minute time frame. It could be the 5 minute time frame. Everything is applied on the same thing. You're going to look at the same setups I give you on this time frame. You're going to look for on the other time frames, even going all the way out to the daily time frame. You see a band, 4 bands down here. All right. The top band, now you might not see any numbers attached to them, and you might have looked at some of my old videos and tried to figure it out because there's only one line, but these are stochastics. Stochastics are made up of 2 lines, a percentage K line and a percentage D line. Now, you don't see the percentage K line on here because we don't use it. George Lane developed stochastics as a divergence indicator, a momentum indicator, not really wanting people just to kind of concentrate on overbought and oversold levels, but really on the shift of momentum relative to the stock movement in the price. And that could be seen internally of how the calculations of stochastics are calculated. And again, you have a K line and a D line. A lot of different platforms give you different parameters for this. What I would like you to use is the fast stochastic, the fast stochastic. Typically, you can run across the fast stochastic, slow stochastic, and the full stochastic. The fast stochastic was the first generation of George Lane's formula. What he did, and then they added another moving average to the formula, and they made it a slower stochastic, slowed it down a little bit further, and then eventually they added another parameter, a full stochastic. And it had 3 parameters. So a lot of people using the trading view will have 3 inputs. They'll have a percentage K, and if you don't see percentage, it'll just say K. So, all right, so I'm old school. It's percentage K. So you'll have a K line, a D line, and if you're using a trading view, you'll have a K line, a D line, and then you'll have a K smoothing line. And the K smoothing line, what the parameters of, or what the stochastics do, is they put the formula together, and what it is, the K line is the look back period of how many periods you're looking back on the chart. The D line, or the D in the formula, is a number that smooths out the K line, and the results are plotted on the D line. So it's a moving average that's placed on the K line to smooth it out. That's all is required, the K line and the D line. If there's any other lines that you need to put in there, put in a 1. All right, because we don't use those. And 1 will be divided by 1, and it won't affect anything. So if you have a K smoothing line, put in a 1 there. All right. Now I have all my parameters on the site. A lot of people. Another big thing is, where do have all your stuff? Well, let me show you that right now. Let me get to Day Trading Radio. But looking up a quote, and I wanted to bring you this quote, but I couldn't find it. So I want to give you the quote tomorrow on the air. And it really, right. So if you log in, into Day Trading Radio. Now, most people have a free trial. They can start off. It's DTR TV, DTR.TV/free. I'll put the link in the description of the video. I turn off the show right now to do this video, so you don't see anything on here. But up on the top of your dashboard, when you do log in, you're going to get a playbook area. You see that playbook? You have forums, HPS videos, everything else you need here, trade alerts. So you're going to go to your playbook. Playbook's going to log in. And right up here, you're going to see chart templates. You're going to say how to set up your charts. There's a lot of great information here, especially the cheat sheets, the business plan for traders, and a lot of lesson plans. And there's 3 pages here, so just make sure you kind of go through all those. But again, how to set up your charts, like DTR, ATM strategies, HPS, triple threat setups. I mean, these might be over a lot of people's heads. Again, there's a lot of information on here that will go all the way back. This is 2013. But these things hold through time. These are playbook trades. These are things that we look for. Over the time, I've managed to narrow our signals down to a very exact entry criteria. Very important that now we have such a good criteria that it's almost worth waiting for that. And that's another big thing for market participants. And I want to say this. Most traders are going to fail. All right? Most traders are going to fail at this. And you're going to be one of them out there that fail or get frustrated and stuff. And it's because you're a human being. You know, when I say that is you're going to fall into the emotions of everybody else. I have the same emotions and the next person. Unless you're a robot, an algorithm, black box or something, you're going to run into the emotions of overtrading, not having enough patience to wait for a trade, not having the discipline to take a trade or take a trade off. All these things have to be perfect to be perfect. Again, I will mention, again, my favorite quote given to me when I was in probably 11 years old, 12 years old, my little league coach, he said, "You guys are not practicing perfect, and that's not good." He says, to make perfect, practice, he goes, practice doesn't make perfect. Perfect practice makes perfect. So when you do these things, you have to be perfect in your approach on this. This is the stock market. This is the biggest financial industry in the world, the richest industry in the world. There's nothing better here, and it's not going to allow a simple Joe Blow off the street to come in here and use the market as an ATM machine. That's the facts. You're going to be chopped up just like chopped liver, just like most of the other traders. Unless you develop a type of discipline, focus, and that makes you a rock star, or makes you an elite athlete in the markets. Just like if you're an elite athlete in sports. To be the great sports player, you have to have the discipline, you have to have the patience, you have to be above everyone else. You have to do more than the other person. All right? Not everyone could come in here and do this. So, again, this is, and I've really wanted to talk about that. I probably should talk about that more, but I want to get this video out of the way. This is very important. I get a lot of emails. I get tons of emails. Too many emails a day. Too many. I answer as many as I can. I follow up the next time. I try to keep up. It's a continual battle with emails. A lot of emails I get are like, wow, didn't they just, take look at some of my lessons and stuff? Where are these questions coming from? And I don't know where they're coming from. I want to be a little harsh on this video, all right? The technique and the method is set for you. It will work. It will be the best thing you ever run across. I'm not boasting that, but I know it. I've been in this market for 26 years, and actively teaching 17 years. I have gotten rid of everything that does not work, and I've adapted what has worked and refined it to a point where it compensates for my lack of discipline and my lack of focus, meaning I put myself in a business plan that I have to look at certain things, put them out there, and make sure that I don't miss them. And that's part of the process, is being in front of the computer. Even though I have, and again, I don't want to jump all over the place. And I want to leave my stochastic bands here hanging there. Let's just jump back there for a second. Again, the top bands here is 9.3. The second band is 14.3, 44, and 60.10. I get so many people saying, "Thank you, John, for sharing all this knowledge and stuff." I said, "Yeah, there's no secrets here. There's no secrets here. It's discipline and patience. That's the secret, and most people don't have that. So I'm not worried about he gives it. I could listen to this, and I could gather all this for free. I don't have to support the site or anything. That's fine too. I mean, there's so many people out there that support the site. I appreciate that, and there's a lot of people that come here and try to just gather what they can and take it and build it. But in the long run, you're going to get busted. You're going to not busted in a way, but you're going to get a fat lip in the market, because the market is tough. All right, and you need that support team. You need that people to do. So even though you have all this information, you have to be in front of the markets to be able to take these setups. So again, 9.3, 14.3, 44, 60.10. Why is there only one line? Because I make the K line transparent. So now we're only looking at the D line. So we have the D line here, and I make all four of them. Now each one of them represents something a little bit different. The 9.3 is the original gangster type of thing. This is the 9.3 and the 14.3 is both what George Lane started off with. Now, if you're not familiar with George Lane, I would recommend reading up on it. Do some research. If you're going to be great at something, you want to know everything about it. So I would read up on it. The 44 is a long story behind that. When I first was developing the quad rotations, the 44 was there. It was a bridge between the 14.3 and the 60.10. It was but it was giving me some good signals, so I kept it. And over time, I've noticed one thing about the 44 is when it gave me a divergence, it did not fail. So it went into the formula, it went into my charts as that. It's not really the most important indicator, but it is when it does show up and gives us a divergence. The 60.10, very important. I've calculated that to give us a gauge of the 5-minute time frame. So when we're looking at a 1-minute time frame and we're looking at the 60.10, that 60.10 is actually giving me what the 5-minute is. So if this is oversold on the 60.10, now I know that the 5-minute's oversold. If this is starting to move up, I know that the 5-minute is starting to move up. If this is moving down, the 9.3, this is the 1-minute, and I know the 1-minute is moving down, and the bigger channel is moving up based off the 60.10. All right? So that's a nice little combination. And again, if you had to only use two stochastics, I would use the 9.3 and the 60.10 combination. All right, so let's get down to a fast review of what we look for as our, and again, what I would like newer traders to do when they watch the market and what you need to be looking for to take a trade. Every trade should be planned out. There should be a reason for every trade. If there's not a reason for a trade, then you're over trading. All right, and your reason should be based off of something that works, not just a random guess or a random area resistance or stuff. Those are seen by a lot of people. Standard stuff like this. And the market reacts sometimes to self-fulfilling prophecy off of support and resistance lines and stuff, but they're still not the best setups in the world. So you have a choice to make. Either confine yourself into trading only certain setups that really, really work, what I call high probability setups, or you're going to go on your own and try to figure it out on your own. All right? It's not going to work. You're going to end up blowing up and taking too many trades. Remember, I have the experience of dealing with hundreds and hundreds, I would say thousands of traders over the years. And it's the same thing with us. So you don't have to believe me. I've kind of gotten to a point where I've gotten a little harsher now, because I think that you need a wake-up call sometimes. The trading is one of the hardest things you'll ever run across. I got an email yesterday. Someone said, "Oh, hey, John, saw you on the Etienne podcast. Loved your style. I really been trading for 5 years. Never really been successful, but now I think I can be successful. These are my goals and stuff." So I try to, I always try to learn about the trader and say, well, all right, hey, thanks for reaching out to me. Tell me a little bit more about how much time you have to spend in front of the computer screen. I'll, try to guide you as much as I can. Well, currently, I can't. I can't. I'm trading the paper trade account, and I can't really trade yet. My goal is to make about $500 to $1,000 a day. So I look at, I said, I said, wow. I mean, what happened to $50 to $100 a day? Maybe that's the overall goal. But all right, let's start small with our goals. Let's start learning how to trade first instead of thinking that the market's going to, feed your family and everyone else connected to it. And where do you come off with thinking that you're going to pull $1,000 out of the market, when you don't have money, to trade with it in the first place, The same thing with the prop accounts. A lot of people say, well, I want to start a bunch of prop accounts and I want to, we're going to compound those and stuff. Easier said than done. It's not like you're just going to go out and do this. It's not, you have to have the discipline and the patience to do this. You have to have the screen time to do this, because the setups I'm going to give you that work so well might show up at 2:20 in the morning. It might show up at 2:30 in the afternoon, Eastern Standard Time. It might show up anytime. It might be 3 of them. It might not be 1 during the day. Whatever they are, when they do show up, they're going to work. So that's really important. That is so important in the markets, is knowing how much screen time you can put in, and will you be in front of the setups when they're there. So that that takes a lot of people out. Like, I'm trading between 7 o'clock and 9 o'clock every day. All right, I understand, but you have to just wait on 7 o'clock and 9 o'clock. You have to wait for those setups, and those setups are not there. You can't try to just make up. Make money appear. I mean, that's gambling, basically. It's basically gambling. It's going into the casino, pushing a button, and seeing which way it's going to go. You might be able to catch it. We have a lot of techniques to help you, 950 reversals and stuff like that, and you're going to do that. And that's going to add to, a gambling phase of the market. Certain things work. Sometimes you get on the right trade and you make a lot of money. Probably the worst thing for you is to be randomly successful with no reason or rhyme behind it. But when you have the good setups and you take it, then you start to build yourself a business, and that's what you want to wait for. So there's a fine balance here that's going to be tough for most traders, because they're not going to have the screen time in front of it. Now I'm going to go over the setup. I'm just going to go through a walkthrough in the market. I'm just going to go back to last Thursday. See, I got kind of the flu on for Thursday. Going into Friday, I was out. This is the weekend. I'm feeling a little bit better, but I don't want to make, you might hear it in my voice. So I'm just going to review this. And I woke up on Friday. I was resting here at the office. I just couldn't be on the mic. It was just too hard. And I woke up on Friday and I saw the greatest setup ever. And I don't know I'm hoping the members of DayTradingradio grab that setup and they all qualify, because when we get to, I want to show you the setup, and this is the ultimate show up, the setup. I'm going to show you that in a little bit. I'm just going to show as we work our way through Thursday and we come into Friday. Friday has the whole ultimate setup. So just wait for that. I apologize for that cough. I don't know if I'm going to go back and be able to get it out of there, because I'm half sick. I really apologize. I didn't know the mic. I couldn't turn the mic off fast enough. I might try to go back and edit that out. If I don't, just deal with it. All right, so here's the markets. And what we're doing is, and again, I'm going to try to walk you through exactly my process of spotting these trades. All right. Exactly what I'm always doing in the markets. It doesn't matter what time, but what I'm looking for is a directional trend in the market. So always looking at directional trends and looking at the different moving averages and the different lines we have on here. We have the salmon colored line, which is our VWAP, and that's very important. It's one of the better indicators on there. Do a little research on that. It's not a video about the VWAP. I'm just going to go over some of the indicators for you. The red one is the 200 period moving average. The blue one is the 50 period moving average, and the green is the 20 exponential moving average. It's not the symbol; it's exponential. Exponential. Then we have a random set of horizontal lines, which are basically outline the previous close, previous highs, current lows, etc., which are always important too. So when the markets open up, we're looking for that trend, and when we have a trend, it doesn't matter how that trend comes up, you'll see it. It's basically a directional move in the market. And what happens when a trend moves, it moves from one direction to another. That's called a pivot. And when you have a pivot, that's typically what we're searching for. We're looking for that pivot and that topping formation. Then I say topping or reversal formation, a topping formation and sell signal, bottoming formation on the buy signal, where we have multiple tops and a lower stochastic rotation. This is not the best one I want to show you, but this is what we're searching for. So our first thing we're doing is looking for, if we have an identifiable channel, we're going to let that channel work. We're going to know how to do a channel. A channel is called a 1, 2, 3 pattern, and I'll show you how to set up a channel in a second. And while we have that 1, 2, 3 channel, we're always looking at, in this case, for buy signals, we're looking for a couple pivots, 1, 2, 3 pivots. All right, when we have 3 pivots, and and a kind of, you could eyeball this, very easy. You're gonna find 2 pivots are gonna be on one side of the chart, either on the top or on the bottom. And when you have 2 pivots on the one top, you draw a line between the 2 pivots. Then you take a parallel line and you drop it to the pivot in between the 2 pivots typically. All right? And that's how you develop your 1, 2, 3 pattern. And you want to trade 4, 5, and 6 if it gets down there. But you always want to watch that 4, 5, and 6, as that's probably where our pivots are going to turn into, that's where our pivots are going to start. So it doesn't mean that every channel is going to give us the signal. It's not. We might get other signals. We have what we call a quad rotation. Quad rotation is when all 4 stochastics get oversold. That means that our 1 minute, 3 minute, and 5 minute time frames are getting oversold. And we tend to get a bigger move in the direction of the move. Now, there wasn't really a pivot here to identify the turn here. So it might not be a trade for us. That's fine. I mean, it's okay not to trade. I'm trying to teach the best setup out there. There's going to be other setups that are going to move the market, but this is the best setup. And if you stick with the best, you'll do good. You're good. If you start to go slumming in the markets and take other setups that are not as good, you could get run over. You could get trapped. You could get, there could be some other. One advice I would say is, if you're ever taking a long or ever taking a short, make sure your 9-3 stochastic is in your favor. Meaning, if you're going to go long, make sure you're coming off of that 20 and heading up. It would also be positive if you had the other stochastics moving up too. That's going to give you the bigger trend. It doesn't mean that it's always going to work. So don't come back to me saying this did not work. The divergence is our ultimate setup with a quad rotation. I'm just saying, there's going to be times when you see a channel move up, and again, I know people are going to overtrade. If you are going to overtrade, at least do this. It maybe will save a little, save your destruction, push it off a little. All right, so again, you have a pivot here, you have a trend line there. You're just throwing these trend lines in here. You're seeing what comes of it, and you're waiting for those divergences. And it might not be one. But if I start to identify a low, a high, here's 2 on this side, 1 on this side, I drop it in. We get back down here. This is where we're typically looking for a trade, down here. Now, as you can see, this was what we call a quad rotation. 1, 2, 3, 4, 5, quad rotation, lower channel line bounce. It's called a playbook trade. It's usually a pretty good trade to buy into the lower trend line on a quad rotation. These are multiple indicators lining up. All right, that's the whole concept of high probability setups, is having a confluence of indicators lining up. The channel line is very important. The quad rotation is very important. Now, this does not mean there's a super signal here. This is just a playbook trade, but very good, a very good playbook trade. All right. Something you probably could actively trade off of. I caught the mic that time. All right. Here we have, and again, time of day here. This is just cruising through this market. You can see that we have two pivots there. What I would normally do here is drop this down here and go here. And then you can start to see we actually started looking at a little double bottom there, but it pushed up here. We came back down and we had this little divergence here. This is where we had the low, the lower low, and the higher low. So this is now what we call our ultimate setup. All right, let's break that down for you. Let's get rid of all the lines so you can see it. Sorry about that. All right. So you had, even though this was a low candle here, okay. So when we get down to the lower trend line, you might have what we call a lip divergence. It's like a little divergence here. You see that little lip divergence? Very high. We're underneath the 200. We're in the lower trend line. In this case, you have a situation where you got an initial pop on that, but it just turned right over and kind of came back down right here. There is a safety net that I teach, and it's called the first rotation of the 20. I mean that you should, if you get a divergence and you're underneath the 200 and underneath the VWAP with that divergence, the trend is typically down, that you take your profits on your first rotation to the 80 line on the 9-3. That kind of, because the trend is usually a friend, and that's one of the reasons why we turn back over and move back down. So even if you had a setup there and you get a pop, you want to get out on that 80 level. But needless to say, that was not a really good setup. It gave you a little pop. Here we came back down to it here, and we're always looking at the closing prices, but you can see that we had a low and a lower low and another pretty decent higher low here. So we have a low and a higher low above this 20 period. That's very important, that the angle of this line. If it's underneath that 20 line, it could be down here. If it's above that 20 line, it's usually going to be higher angle. And this is a real high angle. This is like a 20 degree angle, which is really, really good. All right, and we also are in a quad rotation here. So we have a quad rotation divergence. So this is what we consider a super signal right here. Super signal is when we have all four stochastics oversold, but the 9-3 and sometimes the 14-3, but definitely the 9-3 will give us the divergence. All right. So you have now your identifiable channel, you have your divergence, you have your quad, and you have everything. Once it starts to move outside, starts to turn back up, the next big question I have is, John, when do I get into this trade? Well, it's a visual trade. It's really a visual confirmation when you're looking at the 9-3 and seeing that turn back up. All right, so if you could see, that's why it's important to be in front of the computer sometimes, is to be able to see that. Now, I'll get rid of that circle there just so we can see where that goes. You're not going to get the perfect entry. You're going to have a candle, but what you're going to do is you're going to make sure you're in the trade inside the channel. That's probably the most important thing to do, is if you have your recognizable channel, which is part of the process, and you see your divergence, you want to be in the channel before it breaks out. You want to be in that. You see the divergence, you want to take that trade, right? So right when it's starting to turn up here, it should be right around that first candle, maybe the second candle you get in late. That's fine. Anywhere inside this channel, you're good. So and again, your confirmation is going to be that turn up. That angle, where you could put that angle in. You have to have that angle. And then from that point on, most likely 9 times out of 10 your channel will be broken out. Now we have other things we kind of gauge on. Look, we already had a 1, 2, 3 bigger channel here, so we extend that trend line out, and that's probably one of our first targets is that trend line. So you're in here, right on the 20-period moving average on this divergence, and you want to, again, probably right at this point here on your first pop, because it's a good divergence inside of a channel, I would stress on holding it a little bit longer, but your first exit potential area is on the rotation of the 20. So right around that VWAP. VWAP's been pretty strong for us. But in this case, you're actually holding that VWAP and you're moving up a little bit higher off of that. You always want to have multiple contracts on, be able to identify, to be able to ride these things more than you normally would be with just one contract on. That's why I use the MES or the micros, because even though the the other ones will give you a bigger bang for the buck, it'll also crush you faster too. And not that you're going to get crushed if you take these. It's just that good habits and just being able to scale out properly is always better. Now, typical divergences are what we call low and a lower low, but a double bottom is just as strong. It's really about the relative movements between the stochastics and the price. I mean, if the price comes back down to the original level where it's made a bottom here, gets a little bounce and comes back down to that level, but the stochastics, do not make it back down to that level, that is a divergence. That's just a good one. Sometimes you'll have a candle, and this is more advanced. You'll have a big candle down here. It spikes us down and then pushes back up aggressively with a big candle, and then it pushes up and then comes back, and it comes back down to the candle level. I'll show you examples of that. That's also a divergence, but that's a relative divergence. Very hard to see for the new trader. I have to show you have to work on that. This is a good divergence, double bottom divergence. Just remember, double bottom, regular divergence, both the same strength. They both need to be taken. This is going to be the hard part, is taking your profits off. And where do you want to take your profits? 9 times out of 10, your divergence will break us out of the channel inside the divergence. All right, so market here kind of broke out. You end up taking your profits, and what you're doing is you're waiting for your next trade. Now, the market's consolidating here a little. Not much going on. You get the breakout, you get the continuation move. This is very important down here. That 60-10 is at 85, 87, 90, 89, 90, 91. Remember we talked about, well, I don't know if you remember if you're watching the show, but very important. Once this gets above 90, you don't want to short the market at all. You really don't. You'll be pushing your luck, all right? And if it's holding up here above 85, you should be considered, again, looking at bull flags, looking at continuation patterns. This is a directional strength of the 5-minute time frame. If this breaks 90, then look for a big move up. And right when it did break 90, we did get a strong little move up. So if that's, you get your divergence and then this moves up to 90 and stays up there, you're probably getting a nice little rally. All right, the market moved up. Eventually started coming back down. We started losing it here, started rotating and started drifting back down here. And now you have a downward channel. And again, just from the downward channel, you could let's easily start to see a tighter channel. And now we'll forget about this one because this is after the fact. But come on, Johnny, let me get this trend line going here. If we zoom out here, you can see the high, and then you had a little dip there. So that's what I'm kind of eyeballing right there, this little channel line. All right, and then I see a couple pivot areas, and right when I start to establish those, like right around here, this 1, 2, 3, maybe this starts to hold, and I start to put this in. Then we get down here. I know that this is what we're looking for. So I'm always looking down at the lower channel lines for our trades. Quad rotation. Now, is it a divergence? Not really, but it didn't move out of that channel. The market came back into a nice little steep. This is kind of a nice little channel. You see that wicked candle that came down. Kind of a coiled setup here. We call it coil. 245 coil. And the market here kind of based out. Not much here. Again, going into the last hour. There's no divergence here, and this is what this is about. This is about identifying that divergence. So we want to really concentrate on that. Now, there is an argument here for a double bottom divergence right here. It came down. We started actually moving back up here. That's actually a little. There's an argument for that divergence right here. And you do get that little move up here. But it's not a pure one. It's not a really, it's a choppy one. It was probably near the lows. It was very close to the lows. But once you start to see that rotation on the stochastics and the lows, double bottom, that tends to be a good setup right there. All right, so that was the overnight on Thursday. Then Friday morning, early morning session on Friday. This is kind of what I wanted to show you guys because I wasn't here on Friday. And boy, this was again, the market opens up. Let me fix this. Market opens up at 9:30. We're kind of rallying up. There's no real setups here. That's other than the strength. Here's really good strength. Early on, we kind of ramping up. We get up to that 85, 90 level. The market's really, really strong. The trend is your friend. Until we start to break back down and start to get into another rhythm. So this was very bullish tape this morning. Goes into the first hour of the trade. Then we kind of pulled back a bit. Even a small little pullback, I tend to put these channel lines in, just something small. Now, I wasn't in front of the computer here, so at this time, not to say I would have taken that, but we'd be managing that. We'd be watching that and kind of watching the stochastics on that. All right, that was not a good divergence. Slight divergence. Now, you see the angle here? You see that steep angle? You see that high? And then the high, the double top right there. But you see the drop off right there? Very important. That's a good double top divergence. 12 o'clock. That drop off here, that big angle, that steep angle, 14-degree angle to the downside, it's really good. Normally we like it above 7 degrees, 6 degrees, but if anything steep like that, it's usually really, really good. So right when we start to break down and we cross back over, that's where your short comes in. If this is under the 80 and you have that divergence and this is under the 80 line and we start to turn over and this starts to move down, there's a much better chance that this is going to be a longer trade to the downside. The important thing is identifying the channel. So even if you are trading down here, let's take a look. And we can start to identify, we have that one pivot. You had a little pivot here I put in here. It's kind of holding, not much going on. I put it over here. We'll put this parallel line in here. Actually, you could even, let's actually clean it up a little. Come on. All right, a recap here. Again, there is one setup you don't want to miss. If you're going to be successful in the market, it is going to be the super signal. And the super signal, again, is a combination. Now, first, always take a divergence, but if you have that quad rotation in the divergence, that's always the setup you want. That's the one that I send out on the Voxer on the Future Trade Alert Network. That is very important not to miss it. That's why that is such a valuable tool to have, the Future Trade Alert Network. Again, you low, lower low, low, higher low. Make sure it's above that 20 line. You take your entry, you put your stop in here. The hardest part of this whole process is going to be where you're going to be taking profits. Imagine being in a situation where that is your biggest issue, is taking profits. All right. The other issue is going to be patience and waiting for these things to set up. Not every setup is going to be there for you. and you're not going to be in front of the markets for every setup. So that's a big issue. If we're looking at something happen at 3 o'clock, and then maybe something, or at 1 o'clock, and then happening at 3 o'clock here, another nice divergence here, and a nice move up. And then you had a sell divergence right here at 4 o'clock. Not that we're going to take that one at 4 o'clock, but even overnight, there was a nice divergence on the market open at 6:15, and a nice move up from 10-point move. 10-point move right there. These are the areas you want to be concentrated on. And if you could only trade, say, from 9:30 to 10:30, and let's say you're here at 9:30, and they're like, all right, I'm waiting. There's nothing here. There's just like, all right, we had a little wedge pattern. Do I take? Don't know if you're going to take here. You had a quad rotation if you're going to take that. Actually, there was a little 5-minute divergence there at 9:50. That was actually a decent trade. But say if there wasn't a setup there. Say that you get to that 10:30 area and you're just like, all right, are we going to break out here? You might want to decide to go long here, thinking you're going to break out. Why? Look at your stochastics. Your 9-3. That's your get out of jail free card. Is that in a position where it's going to probably give you a big run or maybe a pullback? So why would you go long here, hoping for a breakout? So many traders tend to buy expecting something instead of just seeing it and respecting it and going with it. Saying that's overbought. Most likely we're going to actually pull back until we get oversold. Then we're going to move higher. So why not buy into weakness? Why not sell into strength? All right. Every single day there's opportunities in the market. 3:45, between 3 o'clock and 4 o'clock. Good setups in the market, especially for those European traders. That's where I'd be trading if I were you. Each week will give us different setups. Not every week is going to be the best setup. There's actually a nice divergence here. But again, if you're not in front of the setup at the time and you end up being trading at a certain setup and there's no setup, you're going to end up trading and taking bad trades. It's just a matter of time before you blow up your account or get frustrated and overtrade. Here's a 6 o'clock in the morning, nice downward channel. These channels get defined by divergence. Once you start to see that higher low, and this was kind of underneath the 20, again, this is more difficult of a trade because I kind of want newer traders to really stick out for the better divergences. But a divergence is a mathematical equation, where the stock is making a low, the stock is making a lower low, and stochastics are making a higher low, showing that the shift in momentum internally is happening. So there will be cases where you might see a nice divergence there. Even though it's under 20, you might decide to take it. I prefer people the higher the angle here, the better the divergence. So most likely, if it's under 20, it's going to be not as great as angle unless it's really dug down deep here and it's higher here. So this is not a bad one. Maybe about 9-degree angle. Typically, we like it above 7 degrees. 10 degrees is really good. There is a little divergence there. So, that's the only reason I would take something like this, because there is a little divergence. No other reason. Why would you take this trade anywhere around here? Because every rotation, 9-3, gets us oversold again. 9-3 oversold. 9-3 oversold. When we have a divergence, then we get the breakout. That's the key to downward channels. These downward channels, once you start to identify them, they're pretty easy to just spot and just kind of just throw them in there, throw those lines in there. You can see the range and then look for those divergences. Upward and downside. Nothing there. But when it shows up, it's go time. That's our business. This is our business. Trading these setups, waiting for them. There's a math reason behind them. There's some better ones than other ones. Sometimes I put stars on them. But I could scroll through a chart like that and spot a divergence like a fart in a closet. Smelling a fart in the closet, but that's gross. I won't say that. I'm about to retract that one too with my cough. Awful video today, Johnny. Anyway, you know what? I tried to get something out for you. Still under the weather with the flu. But I wanted to just touch base on all the new subscribers and say there's a path here to this. All right? There's a path. You have to be, you have to put yourself in the game. Don't expect too much at the beginning. This will all scale once you gain the confidence. And make your goals small. Identify a few trades during the day. Take them. Make about $100 to $300 a day. That's our goal here. Teaching prop traders how to make $100 to $300 a day, and slowly over time qualifying their accounts and then having cash flow. That is the proper way of doing this. Taking gambles, overtrading, you'll eventually get frustrated and it'll blow up. You will. I deal with traders every single day for the last 17 years. I've been dealing with traders. And that's the major thing, So I can only stress it so many times. It's up to you out there to kind of do this. There's no anything I'm going to do to help you. It's up to you to be able to do that. I could show you the setup to take, I could give you the setup when it shows up, and that's why I think I have the greatest product ever, the Futures Trade Alert Network, because you don't want to miss these. So if you're not in front of the computer, join the Futures Trade Alert Network and get these sent to you. And these Super Signal IC, a quad or a Divergence, I'm going to put out. It's going to come across your phone, and you're going to get it. So you're going to be able to get in front of your computer and take these. All right? That's the best thing I could do if you can't watch the show all day. I'm in here. We trade these all the time. All right? All right, so I'm going to be working on the stock watch list. And I apologize for the lack of professionalism on this video. I'm very under the weather today, but I wanted to get something out for you. And at this point, I'm just throwing it out. And I said, if you don't like it, well, there's nothing else out there better. So go try it somewhere else. Have a good night. Have a good evening. I'm out of here.